or worse. It's just been easier to do.
Thank you. Senator Boney.
I brought this up earlier, but I want to get a little clarification of it. I am troubled by the way exchange-traded funds and closed-end funds move differently than the stocks they actually supposed to track. As you can imagine, if those funds do not accurately reflect the value of the underlying stocks, there will be serious consequences as investors lose faith in them. What have you found out about what happened to them?
It's a great question because it's a huge area of focus for us. If you look at the canceled trades, 70% of the issuers who had canceled trades were exchange-traded funds. So we have much more work to do in this regard, but here's what we're looking at. For example, NYSE ARCA is the exchange, the primary listing exchange for almost all exchange-traded funds. So we want to know, did the loss of access to ARCA's liquidity pool when two other exchanges routed around them to trade disproportionately impact the liquidity and the trading of the exchange-traded funds? We want to understand why it was that the severe ETF price declines generally occurred after the single stock price declines and how that linkage works. Did the inability of market makers, for example, to hedge their ETF positions during the volatility contribute to a lack of liquidity? Were there more stop-loss orders that were entered in the ETF markets than with respect to individual stocks? Was that a contributing factor? And did institutional investors short the ETF to hedge their broader market exposure as the market was declining? And so those are the areas we're looking at very carefully. ETFs are a huge part of our marketplace now. There are over 800 of them. They have over $700 billion in assets. Real people were impacted when the ETFs were impacted, and we're going to continue to look at this area particularly closely.
Okay.